Welcome to In Depth for a closer look at what is making mining headlines in the Americas. With the bullion price soaring, producers are pumping cash. Mining Week's contributing editor for North America, based in Toronto, Canada, Matthew Hill, joins me to discuss where they might be looking to spend it. Welcome to the show, Matthew.
Hello there.
Firstly, Matthew, how much money are the gold miners making with prices beating 1,800 per ounce for the first time?
All the majors have now reported their June results, and many of them saw their production going down slightly. Some of them increased their production, but the main thing there was that a lot of these companies doubled their profits compared to the June quarter last year, and this is for a period when remember that the gold price was averaging around $1,500 an ounce. Now we're seeing it close to $1,800 an ounce, and seems to be holding up pretty well above $1,700 an ounce. So these guys really are rolling in the cash at the moment. And I mean, if you look at it from this perspective, Barrick Gold, the biggest producer of bullion in the world, were in the June quarter running at cash costs of around $340, net cash costs of around $340 an ounce. I mean, that leaves plenty of room for margins.
Will all this cash generation pressurize them to do more buyouts?
Almost certainly. I think it's important to remember that investors are still feeling a bit shaky on their feet after the market wobbles that we saw at the beginning of this month. People still aren't sure where the world economy is going. But I think once it does settles a bit in that regard, if in fact it does settle, then there will definitely be a pretty big pickup in the pace of merger and acquisitions in the gold sector. I think another important thing to note is that many of these massive gold mining companies, including Barrick, Kinross, have announced that the giant projects that they're building are going to cost a lot more than they had originally anticipated. In some cases, we're talking $1 billion, $1.4 billion more in capital costs. So I think there's a growing consensus within the mining community that once things do settle down a bit, these big gold miners who are generating a lot of cash, and even the medium-sized guys who are generating significant cash, might be looking to buy projects which are already built or the construction is nearly completed, and they'll pick them up quite cheaply, because gold equities are still pretty much where they were at the beginning of the year, and this is while the gold price has risen by about 30%. So I mean, if you're looking at relative valuations, it may well be cheaper for bigger companies to buy out smaller companies that aren't producing yet but are pretty close to it, and that way these bigger companies don't have to pay these massive capital construction costs themselves, which keep seeming to escalate uncontrollably. I mean, now it's not capital creep anymore. We're talking blowouts here. Also, traditionally, you've seen in the gold space miners doing mergers and acquisitions and paying for them in shares. Now, seeing as though the gold majors and the medium-sized companies and even the smaller players haven't seen their equities go up at all already this year, they won't really be wanting to use them as currency to pay for any potential acquisitions. On the other hand, they're generating pretty good amounts of cash, so I think we're probably also going to see cash being paid more frequently for gold mining acquisitions, and also because of depressed share prices, some juniors might get the feeling that they're worth a lot more than what the market is valuing them at. So I think you're probably also likely to see a lot more of these takeovers in the future going hostile.
And what about diversified acquisitions like Barrick Gold's buyout of copper miner Equinox? Are there likely to be more of those?
I think Barrick's still getting flack about that. And I mean, sure, there are merits in the company having bought a copper project. I mean, like they say, the mine's probably going to generate them a hang of a lot of cash. But at the end of the day, companies' main goals are to see the share price appreciate and to see investors getting a payback from their investment. So, and also recently we saw Stillwater Mining, a US-based platinum and palladium producer, saying that they're going to pay a hefty premium for a South American copper project. Investors also weren't happy about that and hammered that company's share price. And on their earnings call, the CEO of that company had to sit through a long line of questions, and some of them weren't questions. They were almost telling him, drop this deal. So I think gold mining companies would be wise to take note of what's happened with Barrick's acquisition of Equinox and then also the Stillwater more recently. And I think it would probably be best for them to test the waters with their investors before making any of these diversified acquisitions and jumping right in there.
Thanks, Matthew, for joining me. That is the show for today. Please join us again next week for more news and insight on mining in the Americas. I'm Martin Joaquino for Crema Media in Johannesburg.